Hey everybody. So today I'm going to be talking about asset allocation. Um, it's the market has been going pretty crazy lately. It's stressful watching years of savings and profits evaporate in a matter of months, and it makes you want to hit the sell everything button because you never expected it to get this bad. I'm down hundreds of thousands of dollars since the beginning of the year. That's like something like the past 5 years of income, from all sources gone. That's how much money I've lost. And on top of that, I had some crypto in Celsius. It was like a interest earning platform. And recently they suspended withdrawals because citing extraordinary market challenges. Whenever a bank or financial institution keeps people from withdrawing their money, that seriously undermines the public's faith in that institution and often causes a run on the bank when it reopens, right? Celsius isn't a bank, but it acted like one. People deposited their crypto and received interest, and Celsius loaned it out at higher rates, but it turned out they were kind of losing money or just breaking even, so they stopped withdrawals until they figure it all out. They might still recover, and I might be able to get some or all of the crypto back, but I have to assume it's gone. Oh well. I went into this, I put a little bit of money into crypto, assuming it could get lost, and I didn't think it would get lost like this, but so be it. Crypto is very risky. I've mentioned it time and time again, and if you do decide to speculate in this asset class, be prepared to lose 100% of it. Something that's very important for people to understand is there is no get rich quick. Whenever you have a reward that's very high, it will bring with it an equally high amount of risk. Risk and reward, they go hand in hand. You might get lucky for a while, like I did with the crypto, but there's no guarantee that your luck will continue. Now, regarding today's market, Warren Buffett said, fearful when others are greedy and greedy when others are fearful. He said it in 1986 at a shareholder meeting for Berkshire Hathaway. And this was a year before the stock market crashed on Black Monday in 1987. That day, the market was down almost 23% in a single day. And this had never happened before. So like the world was ending. Many people panicked and they hit the sell everything button at that time as well. But if for those who had held on to their investments, it would have been back to break even in about a year. So since 1987, October, when this happened, the market has gone up by over 10% a year. $10,000 investment right before the market crashed in 1987 would be worth over $300,000 today. And if you look at the long-term map here, this 1987 crash was just a blip. You can barely see it, And this only goes until 2014. That's, what is it? 8 years ago, right? So is it? Yeah, 8 years ago. So the market has gone higher since then as well, So the market rewards patience. In the short term, that can be scary, but in the long term, it always goes up. So those with longer timelines, those who are younger, not close to retirement, would do very well to invest mostly in stocks because they're one of the greatest wealth creators over time. But what about the older crowd? People close to retirement, people who may not have time to wait out another prolonged period of no growth like we saw in the 1970s when the stock market was basically flat and they went nowhere for a decade. This is where diversification and properly structuring your assets comes into play. Properly allocating your assets, putting it in the right thing. Stocks have such a high return because they're kind of risky, very volatile. They go up and down. You can lose money in the short term. And there's other investments with less risk, but also lower return. But depending on your risk tolerance, you might want to move some money into these less risky things, depending on how badly losing money in the short term will affect you. But you will, of course, have to accept a lower return. But honestly, it all really depends on your tolerance for risk. If you have a pension or if you have some other passive income, Social Security, something that covers all of your expenses, it doesn't really matter what you do with your investments. You can afford to put it all in stocks. You can afford to take on some seriously speculative risk, because you'll probably never use the money from your investments. And when you pass away, the money will go to your kids or to making the world a better place through charitable contributions. Since you don't need to use that money, you can afford to take more risk, So by the time you pass it on, the money is higher, right? However, on the other hand, if you're depending on your investments to get through retirement and you don't have enough where you can just live off the dividends, like for example, the S&P 500, it's about 2%. So if you have $1 million in the stock market in the S&P 500, you'll get about $20,000 a year in dividends. And if that's enough to cover, if you have enough money where the dividends will cover your expenses, then you're all good. But if not, you might want to think about following the 4% rule, maybe diversifying a little bit, right? You just have to be more careful if you don't have enough money to cover all your expenses, and invest more safely, right? Invest in things that are safer. Some things that people add to provide a little stability includes bonds, gold, real estate, such as through an REIT, a REIT, maybe annuities, and there's some other products, some insurance products. But again, the safer the investment, the lower the return, because that security costs money. You know, it's like insurance, you know, it costs money. I think everyone, doesn't matter your tolerant, even if you're the most conservative investor there is, you know, I think everyone should invest in stocks, should have some money in stocks. But maybe lower your risk a little bit with alternative investments when your tolerance for risk goes down. So let's talk about potential recession, right? Inflation has been eating away at our purchasing power recently, and you've probably heard fears of a recession. Higher prices means people are cutting back, which slows economic growth and possibly leads to layoffs in the future. So what can you do to prepare for a recession? First thing, almost not the most important, but it's up there. Have a 3 to 6 month emergency fund. That means having enough cash in the bank to cover all of your expenses for 3 to 6 months, depending on how secure your income is. If you work for the military, for the government, or something like that, 2 to 3 months might be enough, you know, because your income's secure, you're not going to lose your job. But if you work for something more risky, like a startup that could collapse if there's a recession, you probably want 6 months or more, you know, maybe a year. Now, your emergency fund should not be invested. This is money that has to be there for you. So put it in cash, put it in a high yield savings account, and leave it alone. You know, this will come in handy in case your income goes down, you lose your job, something like that, you know, and this is one of the best ways to ensure you can make it through a stock market drop without having to sell your investments at a loss to pay for your living expenses. Second, diversify. Having all your money in a single investment or even a single asset class can be bad. During the dot-com bubble in 1999-2000, tech stocks fell almost 80%. Back 4 years ago, back in 2018, crypto fell 85%. And this can happen to anything. You know, this can happen to you if you have all your money in any one thing. So it's important to diversify. The more you spread out your money, the more you reduce your risk and your volatility. If one asset, if you have stuff in a bunch of different asset classes, if one asset class fails, the others should more than make up for it. Number 3, keep buying consistently. If we enter a market crash, so keep buying consistently. If we enter a market crash and you still have a job, keep buying those companies at lower and lower prices. Last month in May of 2022, when the market got really bad, I increased my 401k contributions to 50% of my paycheck. And I did that because stocks are going on sale. Might as well buy it, you know, might as well take advantage. I'm being greedy when others are being fearful, right? And I'm going to keep buying consistently with every paycheck in order to hitch my wagon to the engine of long-term economic growth through the stock market, right? And that's because every bear market in history was eventually followed by a bull market. And the bear market, the bull market more than made up for that bear market, right? And if you invested through an index fund that tracks the entire stock market, you won't have to worry about individual companies failing, and instead you own a piece of the entire company. And number 4, panic sell. You know, people think they'll be able to time the market top and sell at a profit and wait till the market bottoms out to buy back in. But we as people, we as individuals, as humans, we're notoriously bad at guessing when that's going to happen. Plus, the longer you're on the sidelines, the more money you stand to miss out. Fidelity did a study to see what type of investor had the highest returns. And do you know who was number one? People who had passed away. Second highest? People who forgot they had an account. So what does that tell us? That tells us that people who leave their investments alone tend to do better than people who try to buy and sell, trade, try to sell at the top, buy back in at the bottom, So just leave your investments alone. Don't panic sell. Make sure if you invest in stocks, make sure you have at least a 5 to 10-year timeline before you sell, right? So messing with your investments is bad for your returns, and you'd be better served by picking the right allocation for your timeline and your risk tolerance, and holding that allocation through thick and thin. Invest consistently and don't panic sell. Number 5 is keep a steady income. Give me 1 second. Somebody chatted here. Oh, okay. The worst case scenario isn't a market drop. It's if the market drops at the same time as you lose your income and you're forced to sell at a loss to stay afloat. An emergency fund will help here, but so will making yourself indispensable at work, maybe learning some useful skills, right? Number 6, Number 6, learn to be frugal. This is how I got to where I am today. The less money you need to get by, the more freedom you have. I can afford to buy a lot of things, but I don't, because I'd much rather see that money put to work for me, making me more money. Save as much money as possible, live below your means, and cut back on unnecessary spending, investing as much of your disposable income as possible. That's what I did throughout my 20s, and I'm in a pretty good spot now because I did that, because I was frugal, because I didn't care what people thought about me. That car right there that you see, that this picture was from a couple of years ago, but now it's at 222,000 miles, and I'm still driving it. I bought it new. It's not worth very much, but it gets me from A to B. Nothing's really broken. The AC still works. I've never had to recharge it. It works. And the money that I saved, not spending, not buying a new car, not keeping up with the latest fashions, not living in more house than I need, gets invested, and that's why I'm in a good position. So the most important point here out of all these tips is to avoid debt. Stay away from debt. If you have debt, you want to get out and you want to stay out, and never, ever, ever invest using leverage. So don't use margin, don't use debt to invest unless you really, really know what you're doing. And one exception is potentially a mortgage or a car payment. A mortgage, when you buy a mortgage like a rental property or something, most people don't have the money to buy it outright, and also the interest rates are lower than what you can get by investing. Sorry, I got distracted. Give me a second. Yeah, so an exception is a mortgage or a car loan because interest rates tend to be low, but it's best that you have no claim on your income, no chains around your neck, nothing holding you back from your investments. So as far as investing using margin, debt can multiply your returns when the investment is going up, but it will multiply your losses if it doesn't go how you think. So as a general piece of advice, just avoid debt. And the last one is invest for the long term. So if you're going to need the money in the next 3 to 5 years, it's probably better not to invest and just to keep your money in cash or something equivalent, something you could easily turn into cash to liquidate. The market is a great wealth creator over the long term, but at times it can take up to a decade to recover. Keep any short-term financial needs in cash or other low-risk investments. Now, if you stick to this advice, you're practically guaranteed to make money over a 15 to 20-year time frame, regardless of what it does in the short term. I say this so confidently because in the entire history of the stock market, a 15-year holding period has never once produced a negative result. Never once, not once, even after the Great Recession, or the Great Depression. So you could have bought right at the top in October 1929, at the start of the Great Depression, and 20 years later, you would have still made money. Bear markets tend to lose about 34%. The bull markets that follow more than make up for it. And if you continue buying in as the market is dropping, you're acquiring your investments at lower and lower cost bases. There's a quote I read recently that I really like. Bull markets will make you money. Bear markets will make you rich. The best opportunities are at times when no one else is buying in. Like Warren Buffett said, be greedy when others are fearful. Now, you're only guaranteed to make you're only guaranteed to make money in the stock market over time if your returns are close to what the market produces. But if you have high fees on your investments, such as high cost mutual funds or a financial advisor that charges you a lot, that takes away, that detracts from your returns, and you may underperform. So many financial advisors charge a percentage of your assets to manage your money for you. And they might charge like the average there, something normal is about 1%. That's 1% of the balance, not the growth. So even if your investment lost money, you'll still get charged every year. And 1%, like if you had $1 million invested with a financial advisor and they charge you 1%, that's $10,000 a year. And that's $10,000 that isn't, getting reinvested and compounding and making money for you. That's lost to fees. And that's not the only fees you might have. Your mutual funds, depending on what investments, what mutual funds your advisor puts you in. They might be, they can run anywhere from, like if you have a low cost index fund, you might go 0.04%, like Vanguard's total market index fund. That's 40 cents for every $1,000 you have in the fund. Or it might go all the way up to 2 or 3%, which is that's a lot of money. It takes away from your returns. Yeah, I mean, a financial advisor that you pay for is, it depends on the person. I don't think it's necessary. I think most people can just read a couple books and they'll be fine. That's really what I did. But if you want your hand held, you might want to seek the advice of a financial advisor. Also for like taxes and insurance and stuff like that. But yeah, a little bit of research, read a couple books, watch my videos, and you'll be set for most people, right? Now, check this out. So this is 40 years, right? This is somebody that invested $10,000, let's say at the age of 20, and they left it alone for 40 years. So by 60, right? They didn't invest anymore. It's just $10,000. So since 1987, the market has produced a return of over 10%. So I just said 10%, right? And this is a 2% fee. So let's say 1% for the financial advisor and 1% for the funds. Just a 2% fee, and you have less than half the amount at the end of those 40 years. So those fees can really drag. Recently, I helped someone that was paying almost 2%. It was 1% to the advisor and like 0.73% average fees on the funds that the advisor put this person in. This is exorbitant. It is egregious, and I wasn't going to stand for it, right? So this person is in retirement age, and let me pull up their stuff. This person is in retirement age, and these were the funds that I had them that when they came to me, they were in. Look at these expense ratios, ridiculous. Look, this one here, the annual fee was 2.22%. Year to date, minus 3%. Over the last 3 years, an average of 2.17%, or an average of 2.19% over 5 years. So they weren't even making enough money over the past 5 years to even cover the fees. So this was actually a negative return. So this is irresponsible to have someone in funds that are so expensive, especially when you can get something you can get just an index fund that does something similar, depending on the risk tolerance and the asset allocation. But it's ridiculous. Anyway, I broke it out for this person in different, like it was bonds, US stocks, international stocks, and cash. And then I created a similar portfolio for them using low-cost index funds. But yeah, they had a total of an average fee of 0.73%, a weighted average fee on all these funds, and their advisor was charging 1%. So they had $542,000 between their Roth IRA and the IRA, and they were paying about $4,000 a year in fees, and then another $5,400, because it was 1% of their portfolio. So almost $10,000 a year in fees. And this is how it was broken out. They had a bunch of cash, they had other investments, they had some bonds, 26%, US stocks, 25%, and international 8%, right? So it was broken down like that. Now, this person has this person has a steady passive income from a business and also some real estate. So they didn't need the money. So I told them, even though they are in retirement age, they're like, late 60s, early 70s. I told them that since they didn't need the money, they could afford to go into something a little more aggressive, because a little more risky, because it more stocks, less bonds, so we worked together, and we came to the conclusion that we would put this person in 50% in US stocks, so total market index fund, 20% in bonds, just to add a little bit of stability. Then we put some 15% in international stocks, and then we put 10% in real estate, in just an investment trust, a real estate investment trust, and 5% we just leave in cash in case there was some opportunity. The market crashes by 80%, might as well buy some more. And so these were the ticker symbols for these low-cost index funds. VTI is the Vanguard Total Market Index Fund, and it has all the publicly traded stocks in the US, something about 4,000 different companies. Expense ratio is 3%, or 0.03%, so 0.03%, 3 basis points. And then you have the bonds is also 0.03%. International is a little more expensive because they have to pick the stocks, buy them, but it's only 0.07%, which is less than a tenth charged by some more actively traded funds, actively managed funds rather. And then the real estate was a tenth of a percent, 0.12%. So the total annual fee that this person now is paying is $236 a year. Compare that to the close to $10,000 that they were paying with their financial advisor, and the more active, the kind of ridiculously expensive fees on these funds, right? So yeah. And all that money that they have saved, the almost $10,000 they have saved, will go to buying more investments and growing for them. So to conclude, I'd like to remind everyone of all of these again. Let's see from the slide. So yeah, don't all this stuff, and thank you for joining in. Be calm when volatility hits in the markets, because it will recover. It will make you money. So just make sure to allocate your assets properly based on your current risk tolerance and your timeline, how much time you need, right? Thank you.